Here, let's bring in Peter Boockvar, Chief Investment Officer at Bleakley Financial Group, CNBC contributor. Peter, I'm sure you just listened to this conversation, and you must be licking your chops because you say the thing to watch here is the move in interest rates, the 10-year especially. Explain.
Well, what's interesting is that the market over the last couple of months, I think, was getting comfortable that inflation's moderating and the Fed's almost done. And then all of a sudden, we get smacked with this rise in long-term interest rates that I don't think anybody, or not many, anticipated. And Guy made the right point that before, that they're rising for the wrong reasons. They're not rising because there's been this sudden acceleration in economic growth around the world. They're rising for the BOJ making a move, the last major central bank to finally join the tightening party. And you guys discussed about all the supply. At the same time, the Fed is essentially selling treasuries. Banks are no longer buying. Foreign central banks are net sellers. And that the market's saying, well, you know, the clearing price for where the 10-year should go with all these moving parts is higher. And I think that was really sort of the surprise over the last couple of weeks.
So you say, you know, the market doesn't seem to understand the point that Tim and Guy just sort of made, which is the idea that rates may go higher, they may stay higher for longer, and Karen as well making the point that is not good for equities.
And this is now all parts of the yield curve. You know, there was one thing to see the rise in the short end because what the Fed was doing. And like I said, I think everyone got complacent thinking that, oh, I don't want to miss the Fed is done trade. And all of a sudden realizing, okay, yeah, well, maybe the Fed's almost done, but the 10-year is now trading at 4.20, and that's a problem. And the 30-year mortgage rate, which is priced off the 10-year, according to bank rate, is at the highest level since 2000. 23 years ago, you have to go back the last time we had a mortgage rate that was this high.
Yeah, it really is amazing. It's one of the reasons why I guess builder sentiment went down the way it did earlier today, as if I'm recalling correctly. Let's talk a little bit about where we began, and that was with the technical support sort of eroding on two of the bell cows of the market, Microsoft and Apple. What is your take there?
So these companies, if we remember, we go back to Q1, and we had sort of very pedestrian growth rates. Microsoft reported single-digit revenue growth. Apple reported a decline in revenue growth. Meta, Alphabet, very pedestrian single-digit revenue growth numbers. And that was cleared of everybody's minds with all the AI excitement. And the beauty about earnings season is that it's always a nice reality check. And what we've seen with this past earnings season, Q2, was that these growth rates are still rather pedestrian. So as great as these companies are, you know, there's still this love affair with them. But their growth rates, they're not growth companies anymore. They're decent growers, but all of a sudden started to trade at very hefty growth-like multiples. And like I said, earnings was a reality check that earnings growth is just okay, nothing great. And I think the decline we saw in Microsoft and Apple, with those two being the biggest, with even after the correction, the combined market cap of the two companies being $5 trillion, that I think that was really noteworthy, was the pullback post-earnings for them.